Hi everyone, welcome to another episode of Talk to See, the first one after the rebrand. If you don't know, we were called Books and Beers before. We changed the name to Talk to See because we want to change our focus to more personal finance and self-development topics. So if you enjoy this video, please consider subscribing, liking the video, and hitting the bell so you get notified. But to get straight to it, a few days ago, I was watching the Iced Coffee Hour by Graham Stephan, which is one of my favorite YouTubers when it comes to personal finance. And he had MeetKevin on the podcast, which is another very famous YouTuber in the personal finance space. Now, it blew me away that they were talking about what they do so that they paid less taxes at the end of the year. And MeetKevin mentioned that one of the things that he considered was buying a plane. Yeah, a jet. Imagine a YouTuber having the money to buy a jet. But MeetKevin said he considered it and then he decided against it because of this clip.
On actually having that asset is massive. But then you're paying depreciation, recapture, the extra taxes. You get screwed.
Now, I know what he meant by this because I studied accounting as a major in college. So that's familiar to me. But I thought to myself that if I didn't study accounting, I would have no idea what he meant by depreciation recapture. I wanted to do this video to give you all the information so you can make your decision as to whether to buy a plane as a tax write-off or not. Keep in mind that you cannot depreciate personal assets. So all this only applies to assets that you have under your business. So if you bought a sick Tesla with Elon's face in it for your personal use, you cannot depreciate it. Now, if you bought a Tesla with Elon's face on it for your business, you can depreciate it. Now that you know that, let's get into it. So when you buy an asset for a business, you don't expense it right away. You have to capitalize it, which means you put it in your balance sheet as an asset. And what you do is that you take depreciation off the asset, and that's the expense you can take off from net income. So when it comes to depreciating an asset for business use, there's three types of depreciation. There's Section 179, bonus depreciation, and maker's depreciation. So let's forget about the first two to keep it basic and focus on maker's depreciation. Maker stands for Modified Accelerated Cost Recovery System, and it's normally a type of depreciation that is used for tax purposes. So let's assume MeetKevin had $4 million of revenue from his business in 2021. To not pay taxes, he buys a $20 million plane. And according to the IRS, a plane that is used for business, not commercial, business, so a jet, is depreciated over 5 years. So if we look at this table, which is provided by the IRS, it shows that we can take 20% of the total cost of the asset the first year. So 20 million times 20% would be $4 million depreciation expense. So you take the $4 million income, $4 million expense, that gives you a total of $0 of net income for 2021. Does that mean that he doesn't have to pay taxes? Yes. But there's a catch. Remember, the IRS always wins. So let's say your net book value after taking out the $4 million of depreciation is now $16 million. And let's say that in 2022, he wants to sell it and he finds a buyer for $22 million. So I'll show you the catch in my iPad. Now here we have a nice little graph. The red bar is the selling price that the buyer is paying. The blue bar is what it costs you to buy the airplane. And the green bar is your net book value, which is your original cost minus the depreciation. So sadly, you can't take a $6 million gain with your capital gain rates, which are way lower. You have to recapture this $4 million. So you have to recapture. And that is going to be taxed at the ordinary rate, which in California, which is where MeetKevin lives, is more than 50% at that tax bracket. So that would end up being a $2 million tax bill, which is pretty huge. And then for the other $2 million, you can use the capital gain rates, which at that tax bracket is 20%, so a lot lower. But you have to recapture that $4 million, which is probably what killed the whole deal. So you have two types of these recaptures. You have the ones we just went over, which is 1245 recapture, which applies to assets that can be moved, like airplanes. And then you have section 1250 recapture, which we'll leave for another video, but it's pretty much the same with some little differences. but $1,250 is more for real property, so land and anything that's built over land. But yeah, hopefully you understand why MeetKevin didn't end up buying the plane. Besides the fact that if he ever sold it, he would have had to pay the recapture, which would have been a lot. He also had to pay $2 million a year of operating expenses, and obviously being a YouTuber, you don't know how constant your income is gonna be. So it's a huge expense that you have to pay for every year. So if you're in a position of buying an airplane and you're watching this video, first of all, thank you. Awesome. Second of all, hopefully you have enough information now to make the decision. I'd say if you can keep it long term and you're able to pay the operating expenses, go for it, but this is not financial advice. Hopefully you enjoyed this video. If you want to check out more content like this one, please consider subscribing, and we'll see you next Wednesday at 5 p.m. Peace.